Hello traders, this is Forensic Forex with Deontay, where we analyze the details and specifics of the foreign exchange market. In this video, I'll break down a simple approach to the New York session. Traders want to utilize the New York session, but find difficulties finding setups because they overcomplicate the process. I use the least amount of data to find entries. If you are interested in how I do so, stay tuned.
Leave the indicators alone.
This will be a three-step process, starting with core curriculum, chart activity, and lesson plan. Let's start off with core curriculum. The London lunch starts at 5 a.m. and ends at 7 a.m. New York Eastern Standard Time. Typically, this session gives traders a retracement or consolidation. I do not look to seek trade opportunities during this time period. The New York session starts at 7 a.m. and ends at 10 a.m. New York Eastern Standard Time. Typically, this session gives traders a retracement to an expansion or a reversal. I look to seek trade opportunities during this time period. Here is a British pound versus US dollar sell setup. We will go through the steps in the chart activity. However, looking at this chart, we can see the two highlighted sessions. The orange shaded area is the London lunch and the blue shaded area is the New York open. And inversely, a buy setup looks like this. So here it's US dollar versus Canadian dollar. The shaded orange area is the London lunch and the shaded blue area is the New York open. For the chart activity, we're going to start off with opening a 15-minute chart and find the liquidity pools in the London lunch session. Next, we're going to wait for one side of the liquidity to be liquidated, so whether that's buy side or sell side liquidated. Then we're going to go down to the lower time frame and find a fair value gap for longs or shorts. Let's take a look at that GU example and UCAD example. The first step, we're going to locate the buy side and sell side liquidity that's forming during the London lunch session. So between 5 a.m. and 7 a.m., we're looking for our buy side and sell side liquidity. So let's take a look at how we find that. So bring it back just prior to 7 a.m. opening price or New York open. And how we find our buy side and sell side is very straightforward. We're looking for the unbroken swing highs and unbroken swing lows. So this is a swing high formation. What makes this a swing high formation? Because the candle on the left has a lower high and the candle on the right has a lower high. That makes this high higher than these two, making it the swing high formation. So that's a very simple way to locate your buy side liquidity. Now the same thing said inversely. To find your sell side liquidity, you're looking for a swing low formation. So we can see right here, just prior to 7 a.m., that's a swing low formation. There's going to be sell side liquidity below it. What makes this a swing low? Well, because the low here is lower than the one on the left and the right. There's a higher low on the left and a higher low on the right. That's the swing low formation where your sell side liquidity is residing. Now at this point, we move on to step 2 of the chart activity. We're going to see what side of the marketplace is liquidated first. Is it going to be buy side liquidity or sell side liquidity? We don't know, so we have to play price action and let it do its thing. So if you play it forward, we can see instantly buy side is rated. We're going to mark off the opening price because it's very crucial as well. So that's 7 a.m. opening price. And we'll talk about why this price point is very influential to the price action and why we need to be paying attention to it a little later in the video. So you can see that's 7 a.m. opening price. At this point, we have buy side liquidated. We move on to step 3, the final step. We're going to go into the lower time frame to find a fair value gap for our entry opportunity. Now, me personally, I go down to the 1 minute. You could use any other lower time frame like the 2 minute, 3 minute, 4 minute, or 5 minute to find your entry. Deontay specifically, for my model, it's going to be the 1 minute time frame. So I'm looking for the very most obvious fair value gap that I can see after breaking that 15-minute swing high. So we're going to play price forward to see if we can find it. No fair value gap, no fair value gap, nothing yet. And there we go. So here we have a fair value gap that forms after taking out buy side liquidity. That 15-minute swing high is that red line. You have a fair value gap forming right there. So if we were to mark it off, it would look like this. That to this. That's your fair value gap. And I'll actually use a box instead because I prefer that. So here to here. That's your classic ICT fair value gap. Yes, there's no market shift occurring. It is just a fair value gap that I'm looking for on that third step. So the final step is looking for the fair value gap that forms on the lower time frame, and there you have it. At this point, I'm going to set up my trade idea. I'm going to look to go short once price hits that fair value gap or the discounted portion of the fair value gap. I'm normally going to do a 1-to-1, very minimalistic. So you could do a 15 pip stop loss and a 15 pip TP, or a 20 pip stop loss or a 20 pip TP. So that's a simple 1-to-1. You're risking $1 to gain $1. So 20 pips for 20 pips. So that's a 1-to-1 ratio. And then after that, I pull the trigger once price hits it and I go in short. So as you can see, that idea, very minimalistic, would have played out very well. However, we can see that price action still hasn't got down to that 15-minute swing low. So if we were to play price out further, we're going to see what happens. I'll speed it up for the video's sake. So this is all off of that one entry. We see price returns again back to that fair value gap here. We'll draw it all the way out to 10 a.m. And you can see eventually it breaks down. It gives you way over 20 pips, that 1-to-1 that you were seeking for. But notice how it went from buy side to sell side. That's exactly what I'm doing every single time for the New York Open session. This is my straightforward model. No indicators, no COT data, no higher time frame directional bias. Just using what I have prior to the New York Open, which is this session here. The obvious areas of buy side and sell side was able to formulate this setup to go short. Now let's take a look at the other example. Following the steps, we'll look back during the London lunch session to find the buy side and sell side liquidity. So just prior to 7 a.m., we're going to go back and find where the buy side and sell side resides. So we can see the highest high just before 7 a.m. is going to be this candle here. So we're going to mark that off as our buy side liquidity. Then we have our swing lows, which is going to be sell side liquidity. We'll make those blue. We have this, we have that one. We have the lowest low as well of the session. So that's all sell side. So we have 1, 2, and 3. Now step 2, we'll just wait to see what price does moving forward to the opening price. So we have the opening. You can see at the open, it comes down and takes out a level of sell side liquidity. We'll also mark off the opening price because this is crucial. So that's 7 a.m. opening price. Like I said, we're going to talk about why that's important towards the end of the video. At this point, we move on to step 3. We're looking for a lower time frame fair value gap. Me personally, I'm going to the 1-minute time frame. I'm going to find the first fair value gap that forms after taking out a swing low. So you can see that's the 15-minute swing low here. We'll play it forward to see what happens in price. And you just have to be patient. As you can see, we have a fair value gap that forms here. So I'll mark it off with a box. So this fair value gap is where I'm going to go long. So once price comes down into it, I'm going to set my long position to go for anywhere from 10, 15, or 20 pips. So let's say we're going in and we're looking for a 20 pip or 15 pip increment. It will look like this. So 15 pips would be somewhere along the lines of this. I'm drawing this pretty high. So that's 15. And then we could do a 1-to-1, like I said. So that's a 1-to-1 setup. So that's where I'll be looking to go long. I'm gonna play price forward to see how that plays out. So we press play. And you see we have that stop loss. We do have some drawdown. And you see how quickly price takes out sell side and runs quickly to that buy side level here. And we get our target of 15 pips for that 1-to-1 setup. So ideally, like I said, this session is just used to gauge what I could potentially have during the New York Open setup. The main takeaway from this lesson shall be these 2 things. Do not concern yourself about the news, higher time frame bias, and COT data. This model is not based on that information. Not one time have I mentioned if the commercials are net long or net short. Not one time did I mention if news was releasing during the New York session. Not one time did I mention if the daily, weekly, or monthly are aligning. We're not concerned about that when it comes to the New York model. Now, that's not to say that the higher time frame bias in the COT data in the news cannot exacerbate the effects of a model. It can. But based on this model, we're solely looking for buy side and sell side that's forming between the London lunch period. And that's going to be 5 a.m. to 7 a.m. Secondly, focus on finding a fair value gap above or below the New York opening price. Now, this is what I was referring to throughout the video. This fair value gap is physically forming either above or below the opening price, depending on the setup. Let's take a look at that GU, UCAD example and a few others. We can see that the fair value gap is physically forming above 7 a.m. opening price. So anything above 7 a.m. opening price is going to be a premium, or as we know it, as overbought condition. In an overbought condition, we know that the market is most likely to give us high odds sell scenarios. And as we can see with the step process of the 15-minute swing high broken, then a lower time frame fair value gap forms above the opening price of the session, we get a high probability sell scenario back down into sell side liquidity, equal lows, and back down to discount. So anything below 7 a.m. is going to be oversold or a discount. The fact that the fair value gap is forming above premium or 7 a.m. opening price, it gives us more confidence that we should be going short, aiming for sell side liquidity, especially after the 15-minute swing high was broken during the London lunch. If you look at the UCAD example, we can see that the fair value gap is physically forming below 7 a.m. opening price. The fact that it's forming below 7 a.m. opening price after taking out a 15-minute swing low, or all the swing lows, or even the lowest low of the session, we can see that there's a high probability chance that a lower time frame fair value gap is going to form and give us an opportunity to go long in a discounted market. So anything below is discount. Hopefully you guys can see that there. That's discount below. Anything above is premium. And you can even see here that price gets above 7 a.m. and there's some type of selling opportunity here as well. So you can see price takes out the 15-minute swing high here. And then the first fair value gap that you can see, that's most obvious, you could probably go short into it, targeting sell side again. And that's exactly what happened here. So there was a buy setup and a sell setup here. They're selling above 7 a.m. opening price and they're buying below 7 a.m. opening price. But the start of this idea was the fact that these 15-minute swing lows, or the lowest low, was ran while getting a fair value gap on a lower time frame for us to grab 15, 20, sometimes even more out of the market. Let's take a look at another example. Gold versus the US dollar, and we can see that the New York session is keying off of a previous session, and that session is most likely going to be the London lunch session, 5 p.m. to 7 a.m. We can see how price is going from sell side to buy side. So it's raiding the sell side, liquidating the sell stops, and running right back to the buy stops. That quick. Now, and that doesn't mean every single day that the setup is going to formulate that picture perfect and give you 15, 20, 30, or even more pips than you expect. But this is something for the traders that want consistency and didn't know how to trade the New York model. If I knew this 6 years ago, I would be well ahead where I am. But I know it now, and I want to share it with the community so that you guys can also utilize it when the setup does form. If you open up to the opening price here and look at this analogy as well, so that's the opening price, we can see how they're buying below 7 a.m.'s opening price and selling above 7 a.m.'s opening price. So if we go in a lower time frame, we're probably going to see that fair value gap that we're looking for and a discount for the buy setup. So price runs the swing low here, that blue line. The very first fair value gap that we could see that forms after running this blue line is here. It's your very first fair value gap. That's where you would go long. You would have a stop loss to deal with this drawdown. Definitely want to be risking properly. Good risk management. And you can see how price eventually runs right back to buy side. And then the same thing also repeats. Notice this fair value gap is below 7 a.m. That is not a coincidence, guys. It's not random. Same thing, vice versa. There's a sell setup here too as well. So there's 2 for 1 here. We run the 15-minute swing high here during the lunch session. We look for the first fair value gap to form to the downside. So we have one here. You can mark that off like that. You can see how this fair value gap is forming above in a premium. High probability sell scenario. So if price is going to sell, it's going to most likely sell in a premium territory. You can see how price trades up into it. You do endure some drawdown, but you can see overall there is profit to be made here. And even into the next day as well, you can see that gold definitely trends a lot lower, giving you a substantial amount of pips just based off of this idea. Looking at the DXY here on April 20th, 2023, we can see the same example is occurring. We can see that price takes out buy side, which is this high up here, this swing high. And after taking out the buy side, we can see it runs down back to the sell side down here. So if you take a look on a lower time frame, we're probably going to find some type of PD array, and most likely it's going to be a fair value gap to go short after breaking this high to take us back down to the sell side liquidity. So let's bring it back to right when it broke. We go on the 1 minute like this, and we'll play it forward just to see how that formulated. So we get close, we finally break it. And we're waiting, and there it is, the fair value gap. That fair value gap right here forms. You're looking to go short inside that fair value gap to the downside. So you're going to probably target 10, 15, 30 pips, or even the actual swing low that formed in the London lunch session. And if you play it forward, we'll speed it up. You can see how quickly it runs back down to sell side. You'll also notice that price itself created that fair value gap above the opening price of the New York session. So that's 7 a.m. right here. It's in a premium. Price formed that fair value gap in a premium above 7 a.m. opening price after taking out the 15-minute swing high. If you notice, all the setups are exactly the same. They are not something very complex to understand, and it's not going to occur every single day back to back. Some people want this model to form every single day, Sunday to Friday. It's not going to be that simple. The market may give you something, and then it might turn around and hit your stop loss. However, it is something that you can use consistently if you don't know any other model. It's pretty straightforward. This brings me to the end of the video. I hope this video was valuable to you as a trader. If you enjoy this video, then I think you'll like these two as well. Please subscribe, like, or comment for more high quality Forex videos. As always, safe trading, leave the indicators alone, and peace.